Hi, welcome back to chapter 9. And the chapter 9, we're going to talk about long-term debt. Honestly, this is probably a little bit difficult chapter that I think when I was learning financial accounting, I had a problem with, but I think you guys are brilliant and there will not be a problem. But to ensure that I clearly convey the most important thing in this chapter, we're gonna majorly focusing on bond pricing, right? So but however, before we get to bond pricing, we want to understand what is the long-term debt, how many kind of long-term debt is usually out there, right? That's gonna be the part A of this recording, and part B of this recording, we're gonna talk about how do we recording bond payment at issue at par, issue at premium, and issue at a discount. And then part C, we are talking about the long-term debt analysis in terms of risk analysis. And then also we wanted to show you how to do the um, bond pricing, right? So without further ado, I know some of you guys have a financial or finance background will find this relatively easier to understand. But for people that does not have a financial accounting or finance school background, this chapter will be a great chapter to introduce you what is a debt, right? What is a debt? What kind of debt out there, and how company borrow debt? Okay. Um, so without further ado, let me share my screen. Um, okay, so this looks great. Uh, okay, first of all, we wanted to understand what kind of type of debt is out there, right? So, so before we talk about debt, we want to know what kind of financing alternative that a company has. Company has a capital structure, right? What does that mean? Means that remember in the balance sheet we have assets and we have debt and we have equity section, right? And then we said asset is resources owned by the company, and to you to own those resources, you can either borrowing or you can ask for investment, right? So therefore, there's a mixture, right? So sometimes people do 50-50. Sometimes they do debt is 70 and equity is 20-30. Sometimes people do 70-20. So there's a mixture of liability and stockholder equity a business uses. So debt financing, we call that borrowing money from bank, right? Or from other from people, right? You can directly borrow money from company or from people out there. People can buy the bond from buy your bond, right? That's what we're gonna cover in future in next topic. So and also you can borrow money from bank. And equity financing is talk about obtaining investment from stockholders, right? You need list your company on the stock exchange, and then people buy and sell your stocks on daily basis, and then that's called people own your stocks, and those people called your stockholder. So from a cost of a financing perspective, we know that actually incur interest expenses. And we know, do you remember interest expenses is tax deductible? Hence that it's reduce our tax burden if you borrow money, right? Because the income expenses is subtracted from net income, right? Hence that the more money you buy, the more interest you incur, and then your revenue minus expenses is your net income. Hence the interest expense is gonna increase the expenses. There's a less net income to be able to be taxed by IRS, right? Hence that's the benefit of debt borrowing. And equity on the other hand, did not enjoy such great benefits because equity actually you are fiduciary duty to give money back to the investors as dividend, right? However, dividend is after tax. Hence, that the money that you give to the investors after. Remember, we call it returned earning. There's a net income, and then some in net income, we can split it between dividend. You can give money to dividend, and whatever left is called a return earning. So dividend, see, is after tax. Tax is already being subtracted. So therefore, if you give people dividend, you are not enjoying a tax benefit of this way of financing. So, and the debts that we are covering here, so that means that borrowing money versus issue stocks, obtaining investment from stockholders, borrow money is cheaper, is actually have a benefit, right? Because you do not need to pay dividend to the debt holders. You only need to pay interest. And the minute that you pay interest, you can reduce your net income, right? Hence that you can pay less tax. However, if the cost of uh, obtaining investment from stockholder is actually you need to pay them what dividend, and dividend does not enjoy the tax benefit. Hence, equity is relatively more expensive financing choices, and then hence that such a great tool. Then why not everybody do borrowing instead of issuing stocks? Okay, that's what we're gonna talk about in the end, part C. And one reason is because the risks. The more money you borrow, the more likely you have a bankruptcy risk, right? Because when one or two times that you fail to pay the interest expenses, the bank or debt owner gonna uh, claim all the resources. They are the first group of people can liquidate your assets. Hence, that the risk of getting a debt is much higher than the risk of issuing stocks. Okay, that's a little bit too much, and then we will talk about in part C. So this book, we're going to talk about notes as a terms of long-term debt, and lease as one type of long-term debt, and bond. And bond, we're going to talk in detail about how do we issue bond, why we issue bond, right? And what is associated one with bond over the bond's life. So the key point here is that companies obtain the external funding through debt financing, which is a liability, or equity financing, which is a stockholder equity. One advantage of debt financing is that the interest on borrowed fund is tax deductible. Okay, so let's see, which of following statement is true? Profit generated by a company are the source of external financing. Not really. This we call it is internal, right? It's if you are actually generating money by yourself, that's called internal financing. We talk about in chapter 1. Dividend paid are the tax deductible expenses. No. And interest paid on the debt is a tax deductible expense. Yes. Okay, learning objective. We are talking about how do we deal with notes payable. So notes payable probably is the most common common long-term debt form that we have in our life, such as mortgages, right? We borrow money to buy a house, and car loans. Everybody in the future, you guys graduate, you're gonna get a loan to buy a car, to buy a house. And then those kind of loans, we call it notes, okay? And most car loans and home loans are called for payment in a monthly installment per way, and rather than a single amount at maturity. I think you guys understand installment, right? It means that you borrow a lump sum, like say 100,000 from the bank, right? And then every month you're paying say $2,000, and then until you pay it off, right, for 30 years or 15 years. That's called installment. Installment, each month you pay exactly same month for a specified period of time. That's called installment. Okay. And then each installment payment including both. So I can divide this $2,000 into two components. One component is that interest that's generated by this amount that you borrowed. Another part is the principal, right? And this $2,000 not only paying the interest, at the same time, it has a component flow to the principal side. So one, we call the interest on borrowed amount. Second, we call reduction of outstanding loan balances, or we can say carrying amount, right? And the companies too often borrow cash using installment notes. So let's take a look at one. So now, as we always do a schedule in terms of depreciation, we wanted to do an installment note amortization schedule for you to illustrate to you how does that note payment installment work. So assume that you borrow $25,000 at 6% for 4-year loan for new delivery truck on November 1st, 2021. Payment of $587.13 are required at the end of each month for 48 months. Okay, so on November 1st, 2021, you got investment, you got a deposit from a bank for $25,000. And then each month at the end of November, you are paying $587.13. That's a great. And then look at how many, we break down this $587 into two components. One component is the interest expenses carried by the borrowing amount multiple the interest rate. And at the same time, 587 minus 125 is almost equal to $462. This amount is to reducing the carrying amount of outstanding loans, okay? So if you see 1 month later, it's still paying, this is called installment, you're still paying same amount for the rest of the 48 months, right? 487.13, but it's breaking down into two components. On the second period, look at your carrying amount become 24,537, then you multiply the interest rate. It says 6%, but it was dividing paid by 12 months, right? Hence that every month you're paying for 0.5%, right? Hence that when you use a 0.05 multiple this new carrying amount that was reduced by previous period, you find that your interest expense on December 31st is actually decreased, right? Because your carrying amount is decreased from $24,000 to $25,000 to $24,537, and then your carrying value. So the installment, the portion goes to the interest is decreasing, and the portion goes to principal is increasing, right? So the reduction, this $464 to reduce the carrying value of the note outstanding is increasing. Hence that the current new interest, the note outstanding is $24,073. So if you continue with this table, you find out in the end, the last period, which is the 48th payment period, your interest contribute the two components, the interest components only $2, and the majority of them go to the principal, right? Hence that you might heard your mom saying that when they buying a house, your parents buying a house, at the beginning of the mortgage, lump sum, a lot of the money is not going towards the principal. The amount that they borrowed is actually going to the interests, right? That's exactly true. Hence that the better that you have a lower carrying value, the less interest that you paying to the bank. So down payment, 20% is minimum, but if you come up with a 50% of the down payment, right? And then your installment payment is gonna much less. And then the interest that you goes to the bank is much less as well, because your carrying value is less. Okay, so how do we journal entry this? Let's say how do we journal entry the initiation of the notes payable. So initiation, of course, you debit cash because the bank give you $25,000. That's they approved your loan, and a credit the notes payable, right, for $25,000. For the first month, which is November 30th, 2021, you first need to debit the interest expense by using the outstanding balance multiple the interest rate for the yearly and multiple 1/12 because it's a monthly payment, right? And then you want to pay, of course, you're going to pay the cash of agreed upon the $587.13. And the difference between this number is goes to reduce the notes payable, because when you debit notes payable, you reduce liability. Hence, the $25,000 carrying value after you journal this entry is going to decrease, right? Decrease for $462. So on the second month, the interest payment is actually generating based on $25,000 minus 462, right? It's a new carrying value multiple the same interest rate, which is 0.5%. And you get the interest expense of $122.69, which is less than previous period because the carrying value is decreasing. At the same time, you pay the cash as agreed, right? Monthly payment of $587. So the difference is goes to reduce the principal amount, right? The principal or carrying value of the loan for $464.44. Okay, so key points to take away is most notes payable require periodic installment payments. Each installment payment including amount that representing the interest expenses and amount representing a reduction of the carrying value, which is remaining the loan balance. So let's see. Tropical Paradise borrowed $24,000 and agrees to pay 5% 5-year installment loan with the bank. Payment of $452.91 are due at each of the month. How much interest should be recorded for the first month? Okay, first of all, we use $24,000. That was the first month, the carrying value of outstanding notes. And then we multiple 5% for annually, and then we multiple 1/12, right? Because it's a monthly. Hence that we're getting how much here? Yeah, we're getting $100 here, right? So, okay. So the payment, yes. Okay, so understanding how the leases are recorded. So second, the topics we'll talk about lease, and then what's most important to know is the present value of future lease payment. It's gonna equals the lease value. Okay, you have to take the present value of future lease payment to calculating lease value. That's the most important thing we need to learn from this. Okay, lease. Lease means that a contractual arrangement by which lessor owners providing the lessee, the user, the right to use an asset for a specific period of time, such as rent, right? We rent apartment, hence that we sign 1-year lease, and then lessor is the landlord, lessee is me, right? And then he give me the rights to live in the property for 1 year, right? So that's leases. And it doesn't need has to be rent. It can be also leasing the equipment and leasing the warehouse, all kind of lease agreement. So leases are recorded by lessee as a debit to lease asset and a credit to lease payable. So basically you debit lease asset and credit lease payable. And then first, what we need to remember is this lease asset, we need to record at the present value of all the future lease payments. And we also needed to record this transaction at the beginning of the lease, such as my lease is starting with January 1st of 2020. So I need to record this journal entry on that day. Okay, so then you will ask me, okay, why don't we buy, right? Why do we need to lease? Okay, there's the following 4 advantage over the purchase decision. First, leasing reduces the upfront cash needed to use in the asset. For example, I don't have money to buy a house, hence that I need to lease a house to live in, right? Hence that the upfront entrance fee is lower, right? Hence that it's easier for everybody to get access to the asset. Second, lease payment often are lower than installment payment. That's absolutely true because installment payment is definitely considering to purchase the whole asset, but the lease is consider saying that if you are leasing an old equipment, that the market value of that equipment is already decreased, right? Hence, the lease payment is often lower because you can borrow for multiple periods, right? But buying, you usually buy new, hence that the installment payment of the new asset is gonna be much higher than lease payment. Three, lease offers the flexibility and the lower cost when disposing an asset. Absolutely. When you're leasing equipment, you can say I only lease 3 years, right? And I don't care. And once it's at the end of the usage, I just give back to my lessor. I don't care to maintain it. I don't care how much the useful life it's left. However, if you're buying an asset, that asset is gonna stick with you for rest of that asset's life. So say 20 years. So and then you gotta make sure that it's always functioning, because if it's not functioning, you basically wasted your investment for next 20 years, right? That's a big chunk of a big decision. And four, leasing may offer protection against the risk of declining asset value. This is absolutely true. For example, if people actually bought a very expensive 3D printer, but the 3D printing technology is rapidly evolving, right? Hence that it's become cheaper and cheaper to get a new 3D printing. Hence that if you lease 3D printers, you can say, well, I like Next. I don't like this model anymore, right? I like the new one. And you just easily return that old one. However, if you bought a old model that at a very expensive price, nowadays it's really hard for you to get rid of it. No one want to buy it. At the same time, you have to recognizing the loss, right? The loss of the asset value. Remember, we always said cost of lower cost of net realizable value, right? Sometimes we always or amortization, right? And impairment. So all these things you need to consider, right, as an asset. Okay, so this is the kind of fundamental reason dividing between the lease decision, which is easy upfront, and also much cheaper to get access usage of the access rights towards the uh, assets. At the same time, it's much more flexible and it's protecting against declining value. Okay, so as we said, the first thing we need to understanding is how to calculating the present value of the lease payment, and we call it annuity. If you're a finance major, you would not be unfamiliar with this word. This basically means installment payment, means every year, you're paying every year, every half year for the same amount. So table 4 at the back of the book providing the present value of $1 annuity. We call it ordinary annuity. And this value are multiplied by the monthly lease payment to get the present value of total lease payment. I will show you in short in 1 second. To use table, you need to know N, which is time periods, and I, interest rates. Okay. However, at the same time, we want to combine of N and I not shown. You can calculate the present value and of the lease payment by using financial calculator or Excel. So I wanted to show you how to do the financial calculator in Excel and then show you how to use the table. Okay, for example, a company agrees to make lease payment for $358.28 at the end of each month for 48 months, assuming the 6% borrowing rate. Okay, borrowing rate, remember, is always meant annual rate. Okay, so then if you use a calculator, you wanted to input the future value of 0 and lease payment, put the key, PMT, payment key. for $352 for 28 cents. And number of payments is N in that calculator. You put it 48 in there because it's a 4-year, right, and 12 months lease. And the interest is a input key as I. You put a 0.05 or 0.5 because it's a 6% for 12 months, so there's a 0.5. And then you click present value. It will directly calculate the amount for you, okay? Which is a $15,000. And then in Excel sheets, you can also list its face value as 0 and lease payment is 358.52 and number of payment is 48 months and interest rate for 0.05% is actually equals to three digit after decimal point, right? And the present value, you can use a present value formula. I will show you guys in a class. So basically you type PV equals B5, which is the interest rate, right? This is the rate first, the cell of the rate. And then you can put a number of payment. So this is an N, and this is payment, and this is future value. And then you put a 0 because it's ordinary annuity, okay? So then you get this number. And what I want to show you is also that, remember we talked about that you can find the table 4 at the back of your book, or you can find anywhere, Google present value of annuity of $1, you get a table. So in this case, it was 0.05%. We don't have in this table, but I just want to show you the table look like this. And I also give you the present value interest factor, right? So this is called a present value interest factor formula. This formula equals 1, okay? This formula equals 1 minus 1 plus R. R is a rate per period, which is 0.5 in our case, 0.005 in our case. And number of periods of 48 period, okay? So you use 1 minus 1 plus 0.005, and this minus n is actually 48. So basically you do this formula minus 1 over 1 plus 0.005, and then 48 square 48 times and dividing 0.005. And then once you calculated this is gonna be the present value in interest factor, and then it's actually equals to 42.58. You will find if this table has 0.005%, it will have a value here for 48 period, right? It will have a value here. Say like this, you just directly use this number representing 20 periods and payment of each month is 2%. And this number meant you have a 10 payment period and each period payment interest rate is 6%. So, but we don't have this on this table because it's too big. I showed you the calculation of the rate, right? So you can generate this number by yourself. And by doing this formula, you should do it yourself as well. 1 minus 1 over 1 dividing. First, you're calculating this component, and then you use 1 minus this component dividing 0.005. You're calculating, you find it's 42.58. You use a payment $352.28 multiply, and you get the present value. I will introduce both method in the class, okay? Okay, so now how do we do the journal entry? Once we find out that the present value of the lease is actually about 150,000, then what do? First, at the beginning of the lease period, we record the lease assets, which is the right to use the lease over the lease period, and we record a lease payable. It's the present value of the obligation to make the payment. So debit, lease asset, credit, lease payable for $15,000, and present value of annuity is n equals 48 period, and interest rate at 6%, but for each month dividing 12. Okay. So while not transferring ownership as in a purchase, a lease gives the lessee, which is user, the right to use asset over lease period. This right is recorded as an asset, okay, and the obligation to make a lease payment is recorded as a liability. Okay, let's look at this. Which of following is an advantage of lease an asset over purchasing an asset on installment basis? Leasing reduces the upfront cash needed to use an asset. Absolutely. Lease payments are usually higher than installment payment. No, it should be lower. Leased assets do not result in a liability on the balance sheet. No, right? We credit the lease payable. And leased asset carrying value includes interest in the asset account rather than the expenses account. No. Okay. So lease asset carrying value including interest in the asset account rather than no, because every time you're paying the payables, you always, whenever it's a payable, you always multiply the 6 dividing 12, you're always generating an expense. Okay, so A. So lease payments are usually lower than the installment payment. Leased assets do result in liability, and the initial recording includes a debit to lease asset and credit to lease payable for present value of the payment. Interest is not including the asset amount. The asset is recorded as the present value, and the interest is recorded each period and charged to the expense account. Okay. And we're gonna briefly talk about the bond, and the next video we're gonna talk about the bond pricing. So what is bond? Bond is a formal debt instrument that obligates the borrower to repay a stated amount referred to as a principal or face amount at the specific maturity date. The borrower also agrees to pay interest over the life of the bond. It's almost similar as a note, right? Or lease. Traditionally, interest on bond is paid twice a year, which is a semi-annually, on the designated interest dates, beginning of the 6 months after the original bond issuance date. And there's several different kind of bond. There's a secured bond, means that require collateral. Bonds are backed up by collateral, meaning that when you borrow somebody money, you need to put some assets saying that if I fail to pay, you can take away my TV, my house, everything else, right? Unsecured bonds means that bonds are not backed up by collateral. Term bond means the bond issued maturity at a single date, means that you pay interest along the way, but you have to pay everything. So say you borrow $1 million and the $1 million is due 10 years from now that day. All of a sudden, everything you pay off. Serial bond means the bond issue maturity in installment, means that over the next 10 years, every year you pay $100,000, right? And a callable bond means the issue company can pay off the bond early, meaning that whenever I feel like I don't want to borrow money anymore, I have enough saved up, I wanted to cancel my debt, you have ability to do that if you have a bond that is callable. And sometimes bond cannot callable because you didn't have that clause in your contract. And the convertible bond means that the investors can convert the bond to common stocks. And in other words, the bondholder, which is debt holder, can become your equity holder. That's called a convertible bond. And let's look at the time of the bond issuances. Say on January 1st, 2021, California roller coasters raised money for development of new roller coasters by issuing $100,000 of bond and paying a stated interest rate of 7% each year. And the bonds are due in 10 years, okay, with interest payable semi-annually on June 30 and December 30 each year. So what that means that in every half year, you are paying 100,000 multiple 7% and dividing 2, which is a $3,500. Okay, so and then you're gonna do that for how many period? 20 period, right? Okay, so if I draw a timeline, it was starting with January 1st of 2021, which is the issuing date, till next 10 years, which is 2030, December 31st, mature. And then the face amount is $100,000, right? And the interest payment is a $3,500 each month. So basically what we wrote, 100,000 multiple 7% dividing into 2 semi-annually. So you're gonna pay 20 times 3,500 over the life of the bond. Okay, so amount investor, so right now, in order to buy this bond, in order to invest in this bond to get paid $3,500 each month, how much should we deposit to the company? How much if they are borrowing from you, right? For let's say 10 years, borrowed $100,000 from you at 7% a year, and then you say pay you someone annually, and then you know from now on every month, every half year, I have $3,500 cash inflow. But how much should I buy? How much should I deposit to this person who want to borrow me money, right? That's what we call the amount investor willing to pay for the bond. Okay, this is gonna be our topics for the part B. Okay, that's when we talk about the issue at the par value, issue at the discount, and issue at the premium, and why some bond can issue at a par, or some issue at face value, let's say, and then some has to issue at discount, some has to issue at a premium. We're gonna give more detailed explanation. So the key point here is that to distinguishing the characteristics of a bond, including whether they are backed by collateral, secured or unsecured loan, they become due at a single specific date or over series years, called a term or serial bond, or can be redeemed prior to the maturity, which is called a callable bond. And we're also going to talk about the retirement of the bond, and then you will see the callable choices is very important. And then or can be converted into common stock, which is convertible bond. So that's for now you need to know these different types of bond. Okay, let's see. Which following for bond always mature on a single date, right? Term bond, right? Term bond is the $1 million you got to pay at that all of a sudden one time. Okay. Okay. I will see you guys in the next video, because if it's too long, that's you probably fell asleep already. Okay. See you next video.